Hello, everyone. Welcome back to Company Founding 101, Class 7. I'm George Sun, like always, and this is sponsored by Sun Endowment. So, today we're going to talk about cash flow and capital management. You might ask, what are some components that makes up of cash flow? We have mentioned this in Class 5 that there are inflows and outflows. I didn't explain what it was at that time, so now let's get deeper into it. Inflows means elements like revenue, of sales, investments, loans, proceeds, or money from other owners' investments. And outflows means it's going out. The money is going out. Thus, it's cost outflow and operational costs such as rent, salaries, expenses, and stuff like that. And other components, including operating activities, investing activities, and financing activities. So operating activities means the cash received or spent because of internal things happening in this corporation. It might be, the production or the sales and the delivery. And there are investing activities, and this includes buying and selling assets. For example, I bought this real estate factory and then decides to sell it because it has grown tremendously. Thus, that counts as investing activities. Lastly, there are financing activities, means there are inflow of cash from investors, such as banks and shareholders. So if they give me money or I pay dividends to them, this has to be go into account of financing activities. And there are positive and negative cash flow. I think this is pretty intuitive because positive cash flow means the liquid assets are increasing and it is enough to cover the expenses, which is good. And the negative cash flow means the liquid asset is decreasing, means it cannot cover the expenses anymore, which means the company is in financial trouble. And let's talk about working capital management. It involves managing the relationship between a firm's short-term asset and short-term liabilities. So let's just I'll remind you what assets and liabilities mean. Liabilities means debts that you owe to a third party, and assets means the things that you own, like factories and stuff like that. And effective working capital management ensure the company operates smoothly and has enough to cover both short-term debt and upcoming expenses. So you're not going to be in financial trouble. Thus, we need to use cash flow forecasting to do so. And it involves creating an estimation of the amount of money that is expected to flow in and out of the business. And it helps you know when you might have extra cash and when it might run short. I'll give you a really quick example of cash flow forecasting. Let's say I'm producing wood, and it changes monthly, and the fixed cost for holding these woods in my factory is $10. So I need to put that in forecast because those might not sell. And there are some budgeting techniques. Zero-based budgeting, which means it starts from zero and you look at every single item. And these are basically the repeat of what we have discussed last time. And why am I mentioning this again? Because budgeting is so important. And a lot of you guys might not look at the last week's episode, but you should look at this again. And this is a more concise version. And incremental budgeting means the last period's budget as a base and as a certain percentage increase or decrease or a fixed amount, like I discussed in the last one. And activity-based budgeting means it focuses on budgeting around activities and projects that drive costs in the company. So believe you can be successful, and thank you so much for listening. Please email me if you have any questions and if you have great ideas that want me to invest. So see you next week.